The free techniques behind winning in trading in any market. Now, every single trader should know these techniques because they're the difference between huge drawdowns and consistent growth. It's also the exact same techniques I've used to go from inconsistent results to 15.9% returns last month across my automated portfolio. Now, these techniques have helped me push size across futures, equities, and even crypto without blowing up my account. And here's the thing. The biggest funds in the world also use them, such as Renaissance Technologies, Bridgewater, Man HL. They use the exact same techniques. Even the new Chinese version of Jim Simons, he did 56.6% returns last year and also was the founder of DeepSeek. I just made an article about him on Twitter where you can learn more about him if you're interested. Now, while they might be doing a more complex version with advanced portfolio construction and risk modeling, the core concepts stay the same. And the reason I'm making this video is I got this message last week where primarily he's asking me, how do I maintain these really decent results across many months? And what is the most important concept that defines my success? Is it, one particular thing like position sizing, or is it, a different version of technical analysis? Is it because I'm using binary or continuous signals? And 5 years ago, I probably would have asked the exact same question, but I was making the exact same mistake. He was searching for the one thing I was doing differently. The secret indicator, the magic parameter, the special approach. Most traders think the answer is finding that perfect strategy, the one that never loses. But after building hundreds of strategies over the past 6 years, here's what I told him. The answer is simpler than you think, but it's harder to implement than you'd hope. The single biggest factor isn't sexy. It isn't some secret indicator or advanced optimization technique. It's actually diversification. Now, here's what my portfolio looks like on an individual strategy level. So as you can see, there's a lot of different ups and downs, and it's not as smooth as the top equity curve because that's all of the strategies combined into one equity curve. And I know most of you have probably heard of diversification before, and it somewhat sounds boring, right? Most people are thinking of Warren Buffett and, diversifying your portfolio in that side of things. But here's what nobody tells you about diversification in systematic trading especially, and why most traders get it completely wrong. So let me show you these free techniques that changed everything for me and exactly how to do them that surround diversification. First, let's get rid of this myth of what diversification actually is. What most traders are doing, especially what I see online, is they'll backtest a strategy. Historically, it seems to work, so they set it live. They then add another strategy with slightly different parameters, and it also seems to work, so they put it live as well. They then add a third strategy. Maybe it's slightly different, maybe they put it on a different time frame, but it's the same sort of derivative from the same initial strategy. So now they're running free strategies that, at least them, seem quite diversified, right? But unfortunately, they're not. When the market regime breaks and all three strategies break down together, your strategies are ultimately correlated. They're essentially the same bet wearing a slightly different costume. And in case you don't really know much about correlation, let me just quickly explain it. So you have +1, which means positive correlation. They move together. You have 0, which is no relation, so they move independently. And you have -1, which is perfect negative relationship, meaning they move opposite. So what in this example they had done is they've multiplied their exposure by 3, because technically they have one single strategy, but they have 3 derivatives of it, and they're pushing size to each one of those, meaning they've increased their exposure by 3 times. And that's all because they are correlated strategies. And in case you've watched my monthly recaps that I upload to this YouTube video, you'll notice something from the 12 strategies that I'm running. Almost in any given month, I will have some of those 12 strategies losing in that given month. I'll never know which one is ahead of time, but that's the exact point. The other strategies typically pay for those losses and then some. That's what ultimately smooths out my equity curve and keeps me out of extended drawdowns. And because I run 12 plus strategies across different markets, timeframes, and logic, all with the goal of them being uncorrelated to each other, that's why it's possible. So the first main technique that you need to do to actually be properly diversified is start with fundamentally different logic. You don't want to build variations of the same strategy. You want to build strategies with fundamentally different logic. For example, start with 3 to 4 core strategies that think differently about the market. So for an example, strategy 1 is trend following. So this is the classic that most people are doing. You're buying strength and you're selling weakness. It works in trending markets and it fails in choppy and range-bound markets. An example of this, it could be a moving average crossover, a breakout system, momentum strategies on the daily time frame, all those sort of things. You've got strategy 2, which is mean reversion. So you're buying weakness and selling strength. This normally works really well in range-bound markets or low volatility markets, and it fails when trends normally persist. Easy example of this is the classic RSI overbought and oversold, or Bollinger Band extremes, for example. Now, you should notice something between these two examples. They're fundamentally doing well in opposite market conditions. When trend following is struggling, mean reversion thrives. When mean reversion bleeds, trend following is doing really well. And then the third example would be arbitrage, or something that's maybe market neutral. This is ultimately exploiting price discrepancies and works regardless of market direction. So this could be cross-exchange arbitrage, pairs trading, funding rate strategies on crypto, but ultimately it's completely unaffected by the direction. So here's the framework. I would probably recommend starting with 2 to 4 strategies that have different entry logic, different market assumptions, and different optimal conditions. Don't try and build 12 strategies on day one. Start small with fundamentally different approaches, and then ideally you want these strategies to naturally perform differently in different market regimes from one another. Now it's all good, me saying this, but let me actually explain how the math works behind this. And I thought, who better than Ray Dalio, the founder of Bridgewater, one of the largest funds in the world, explaining this exact concept that he calls the holy grail concept in trading.
% average return and a 10% risk, and you add in a second and a third and so on. You're not going to lose the 10% because you're still going to have that 10% return, but you're going to then have a reduction, and that's the reduction in risk. And if it has a 60% correlation and you have 3 or 4, you will get a reduction that maybe is about 15%. And you could add in 1,000 if they're 60% correlated, and you're not going to reduce your risk much. Okay, that's important. Now, if I look at that, how that changes according to the levels of the correlation, I start to think, well, what would happen if I added in something that had a 10% correlation, by way of example? Okay, now that's what that line shows, okay? And it shows how much, okay, at about 7 or 8 or so, I cut my risk in half. That means I've doubled my return relative to my risk.
Now, the second concept is trading everything under the sun. You want to deploy your strategies across multiple markets. 2025 was my biggest trading year. Want to know which market carried me? Well, it was commodities and crypto. Could I have predicted that at the start of 2025? God, no. I never would have seen metals running this much. This is why the biggest trend following funds trade everything under the sun. They're not trading a ton of markets because they think they can predict which one will have a trend. They're trading tons of markets because they know they can't predict it. They're waiting to catch those trends and being there when it happens. Here's the practical approach. Take your trend following logic and run it on maybe equities, crypto, and even commodities nowadays. That's how you capture opportunity without predicting it. Now, this will take a bit of time. Different markets have slightly different infrastructures and restrictions. The easiest ones I'd probably say to get started with is maybe crypto and futures. But ultimately, the effort is really worth it because you're no longer betting on one market to perform. You're betting that somewhere trends will exist and you're going to be able to capture them. One caveat I will say for this is you can have the same sort of idea for trend following strategy, but it can have slightly different parameter values in different markets. The reason being there is different markets are going to have slightly different volatility, they're going to have different characteristics, and you can slightly tune to that, right? It doesn't need to be the exact same parameter values, but most of the time if you build a solid, simple trend following strategy, it should for the most part work across different markets as well. Now, number 3 is measure and manage correlation. This is the one most traders completely ignore. You need to actually measure correlation and adjust accordingly. It's not enough just to run multiple strategies. You need to know if they're actually uncorrelated or at least low correlation. While backtesting these strategies, measure correlation over time. And if you don't know how to do this, definitely check out the backtest bootcamp, as we have some template codes and all the info you need to backtest strategies. And as we mentioned in the bootcamp, one of the most important things with this is measuring during stress events. Because here's what happens. During a normal market days, your strategy might have a 0.2 correlation to the other strategies. Looks quite low, looks great. But then when a stress event happens, like tariffs or 2020, correlation spikes to 0.85 or to 1, for example, for your strategy correlation. Now, all your strategies are losing together, and this is what we'd call a correlation breakdown. You want to target correlation as low as possible, ideally under 0.5. Even better if you have some strategies with negative correlation. But that will be quite hard to find on stress events. As the market has got so global nowadays, most markets are going to be hit if there is a stress event. So if you can even get to near 0 or 0.5, I'd say it's a really good portfolio overall. Now, what's the result of all this hard work? Well, you're going to have much smoother equity curves, smaller drawdowns, and more consistent returns. Because when one strategy bleeds, the others don't. For example, this is my correlation matrix from the last month. As you can see, there are some pockets of high correlation. I kind of talked about this on my last video about how I'm going to maybe target and fix that. But for the most part, you can see all the rest are quite low or slightly even negative correlation, which is great to see. Now, how can you actually build this today? Well, first I would start with 2 to 4 core strategies with different logic as I mentioned earlier. You could do trend following on the short term, medium term, and long term. Then you could do mean reversion on the short term, medium term, and the long term. And then maybe strategy 3, try and do arbitrage or something different that isn't dependent on market direction. 2, you want to measure correlation and adjust for those. So make sure to backtest all the strategies and calculate correlation as well. Step 3, deploy each strategy across different markets. Take your trend following logic and run it on indexes, crypto, commodities. As I mentioned earlier, the easiest ones here is probably going to be the crypto markets to start with, and then maybe futures. Step 4, size each strategy equally. Now, this isn't the optimal approach, but it is the easiest approach. Portfolio construction can get quite complex, especially with sizing. So later on, maybe you could do weight based on volatility or performance of those particular strategies. But at the moment, just start simple. If you start a low amount to each particular strategy, you should be fine for the most part. And step 5 is rinse and repeat for the most part. You have to just add new strategies incrementally. Normally, you can add 1 to 2 strategies every couple of months. But once you start getting to around 10, it can become quite hard to add more strategies there that are actually low correlation. And to be transparent, diversification, at least for the benefits, you'll get most of the benefits around 5 to 10 strategies. After that, you're still going to be getting benefits. It's just a less increment of like benefits for each particular new strategy you're adding. So primarily you have diminishing returns. So this is how you build a portfolio with smaller and more controlled drawdowns. As I mentioned earlier, if you want to learn how to build systematic strategies and have me guide you through that whole process, check out the backtesting bootcamp. It's a bit of a shameless plug, but it has generally helped hundreds of traders get better at backtesting and even deploying strategies live.